Okay, let's unpack this. We're diving deep into a topic that really separates the casual observer from the truly disciplined participant.
Yeah.
The language of amplified financial exposure. We're talking about leverage trading specifically, decoding margin, position size, and, understanding the true cost and function of your profit and loss, or P&L.
This is such critical material. Our sources really highlight that for anyone learning, the immediate goal has to be moving beyond just buying an asset outright.
Right.
You have to understand what it truly means to control a large position with borrowed capital. When you use leverage, the rules just fundamentally change.
Absolutely. Our mission today is to cut through that terminology. We need to define those critical concepts, expose the three major risks that amplification introduces, and, well, give you the essential checklist to manage those risks.
Exactly.
Because ultimately, this entire deep dive hinges on one core idea, right? Knowing not just how to place a trade, but what you are truly exposing yourself to.
That's it. That is the key. The relationship between that small amount of collateral you post your margin and the huge position size you control is the single most important factor in risk management here.
Get that wrong, and you're done.
Get that wrong, and liquidation is, well, it's pretty much inevitable.
So to begin, we have to start with the most fundamental decision you make in any market, the directional one. You're really only betting one of two ways.
Exactly. When you enter a leveraged contract, you are taking a directional position. So the first and most common is the long position.
The classic buy.
The classic buy. You anticipate the price of the asset is going to go up. Your profit starts if the price rises above your entry point, and, you start losing if it falls below.
And then there's the necessary flip side, the short position, or sell. This is where you actually profit from a decline.
Right. You're betting the price will fall. If it moves down below your entry, you gain. If the price moves against you and rises, that's where you take the loss. That's it. Those are the only two options.
Okay, now let's demonstrate why leverage creates such a dramatic difference from traditional trading, what we call spot trading.
Yes. This is the moment where that power of amplification should become crystal clear for you listening.
Let's use that simple $100 example from our source material. In a traditional spot trade, you buy $100 worth of Bitcoin, gold, whatever. If the price moves up by a very respectable 5%, your profit is just $5. It's safe, it's straightforward, but the gain is totally capped by your capital.
The math is linear. You have $100 in exposure. A 5% move nets you $5. If it falls 5%, you lose $5. Simple. Now let's step into the world of perpetual contracts.
And leverage. So let's say you still have that same $100, but now you commit it as margin and you use, say, 10 times leverage. Can you walk us through how that changes the exposure?
Certainly. That $100 you put up multiplied by 10x means you now control a total position size of $1,000 in the market. You are only using $100 of your own capital, but you have 10 times that much riding on the trade's outcome.
So if that underlying asset moves up 5%, the exact same market move as our spot example, your profit is calculated on the $1,000 position size, not your initial $100 margin.
Correct.
That 5% move instantly results in a PnL of plus $50. That's a 50% return on your capital.
From a modest 5% price change, yeah.
Incredible.
And this is where we have to emphasize that danger is symmetrical. That same 5% move against you, that's a $50 loss, instantly wiping out half of your initial margin.
And that leads us to the critical concept that high leverage traders fear: liquidation risk.
Liquidation.
It's brutal. Can you walk us through the actual mechanism? What does the exchange do, and more importantly, why?
Well, the exchange's primary goal is to protect its own capital, which it lent to you in the form of leverage. They will not allow your position loss to exceed the collateral you provided.
So if the market moves against you enough that the cash you put up, your margin, falls below the exchange's minimum maintenance requirement,
They will automatically and swiftly close your position.
they just force sell it.
Exactly. They liquidate it to prevent you from incurring losses that would become bad debt for them. And the terrifying takeaway for a beginner is that the higher the leverage you use, the closer that liquidation price is to your entry price.
You have no buffer.
Virtually no safety buffer at all.
Which brings us to part two. Because so much of the confusion for new users comes from, well, conflating those two numbers. The small bit of collateral and the enormous exposure. Let's really formalize these definitions.
Right. When you look at your trading screen, you see two key numbers: Margin is the actual collateral, your own funds that you provide to open and maintain the trade. It's like the gate fee.
But the number that really dictates your fate is the position size. Again, that's always calculated as your margin multiplied by your leverage.
Why do we need to stress this idea so relentlessly? Because beginners look at the margin, say, $200, and think, okay, my maximum loss is $200. And that's just incorrect.
It's not, yeah.
Your PnL is based on the $20,000 position size you control if you were using 100x leverage. You have to shift your thinking away from that small cash outlay and constantly think about your risk based on the total market exposure.
And once we've calculated that raw profit or loss from the market move, what our sources call gross PnL, we have to confront the net reality.
The net reality, indeed. Net PnL is the final amount you actually walk away with, and it is almost always less than the gross number, especially in leverage trading.
So the calculation is gross profit or loss minus trading fees and minus funding fees. Trading fees are pretty straightforward, but funding fees, that's a unique complexity of perpetuals that trips up so many people. Can you elaborate on how those work?
Funding fees are they're periodic interest payments, usually every 8 hours, and they're designed to keep the price of the perpetual contract tethered to the underlying asset's spot price.
And this is crucial. The traders holding positions pay these fees to each other, not to the exchange.
Precisely. So if the majority of the market is long, the longs pay the shorts. If the market is mostly short, the shorts pay the longs.
So if you're in a long position during a bull market where everyone is long, you're probably going to be paying a small fee every 8 hours.
You will. And if you hold that $10,000 position for, say, 2 weeks, those small periodic payments really add up, often without the trader even realizing it.
Let's just put a number on that. Say you make a gross profit of $200 on a trade. You held it for 5 days, you incurred $15 in trading fees and another $40 in funding fees.
Suddenly your $200 profit is only $145.
That's the net PnL shock. It can turn what you thought was a great day into an average one, or an average day into a loss. You just can't ignore this cost.
It's non-negotiable.
Here's where it gets really interesting. We have to challenge the narrative around leverage. It's marketed as this quick path to wealth, but the sources emphasize that its fundamental purpose for sophisticated traders is actually capital efficiency.
That's the key distinction. That's the difference between a speculator and a disciplined trader. Leverage allows you to achieve a desired market exposure, say $5,000 worthwhile, tying up less of your total capital.
So you might only need $500 in margin.
And that leaves the other $4,500 free to manage risk or pursue other opportunities. It's about maximizing the return on deployed capital, not just gambling for higher gains.
So if you use it wisely, at low multiples like 2 or 3x, it's a strategic tool. But the moment you start pushing 20x, 50x, 100x, that efficiency just becomes catastrophic amplification.
It does.
Yeah.
And we need to dissect the 3 amplified risks that come with high leverage.
Let's do it.
Okay, risk number 1. Liquidation proximity. This is the distance between your entry price and the point where the exchange closes you out. The relationship is inverse and unforgiving.
So with 100x leverage, the market only needs to move 1% against you.
And your margin is completely wiped out, gone.
A 1% move can just be market noise. That can happen in 60 seconds during high volatility. So high leverage just removes your margin for error.
It removes the buffer for volatility, precisely. Risk number 2 is total margin loss. We touched on this, but it bears repeating. Losses are amplified at the exact same rate as gains.
Right.
You might see a 10% drop in the asset, which seems manageable, but because you're using 10x leverage, that small drop results in a 100% loss of your initial margin. Your collateral is just gone.
Even though the asset price barely budged in the grand scheme of things. And what about the third risk? This one's a bit more nuanced, the maintenance requirement trap.
Yes, this is where beginners get really confused because they think the maintenance requirement is static. It's not. Risk number 3 is higher maintenance requirements. As you open larger and larger positions, the exchange requires you to maintain a higher percentage of margin.
So a small position might only require, say, 0.5% of the position size as margin, but if I use 50x leverage and have a massive position, that required ratio might jump to 1% or even 2%.
Exactly. The required safety buffer itself gets bigger as your exposure grows, which shrinks the practical distance to liquidation even further than the simple leverage multiplier suggests.
It's a double whammy of risk.
It is a double whammy.
This all just emphasizes the golden rule, the single most critical lesson from all these sources.
Yeah.
You must always size your position based on the specific dollar amount you are willing to lose.
Not the maximum leverage the exchange allows you to use.
Right. That 100x option is a warning, not an invitation.
Absolutely. So once you understand the math of risk, the final piece of survival is pure discipline. It's about knowing when paper profits become real.
And this is where we have to talk about the distinction between PnL that is potential and PnL that is locked in. The realized versus unrealized PnL distinction. People learn this the hard way.
They do. The car analogy really helps here.
It's perfect.
It is. Unrealized PnL is like checking Zillow and seeing the estimated value of your house has gone up $50,000. It looks great on paper. It fluctuates in real time.
Yeah.
But you only realize that profit, you achieve realized PnL when you actually sell the house and the cash is in your bank account.
That's the locked-in value. From a technical trading perspective, what causes the difference? It comes down to which price feed the exchange is using, right?
Precisely. This is a crucial technical insight. Unrealized PnL is calculated using the mark price. And the mark price is it's a calculated reference price that often averages price data across multiple exchanges.
And it's designed to be less volatile.
Exactly. It's designed to prevent unnecessary liquidations. If the market has a sudden temporary price a spike down that instantly recovers, the mark price keeps the position open. It ensures you aren't liquidated by just, transient noise.
But the final number?
The final number, your realized PnL, the cash you get when you exit, is calculated based on the last price. And that's the actual settlement price of your trade on the exchange's order book.
That makes perfect sense. The mark price protects you while you're open, but the last price is the ultimate reality of closure.
So let's move to the action items. What are the 3 most common PnL mistakes that beginners make, and what are the fixes?
The first and most common is behavioral. It's treating unrealized PnL as guaranteed or safe profit. People start mentally spending the money they see on their screen.
And the fix is simple, but it requires immense self-control. You have to remember, it is only paper profit until the trade is closed. The moment you see a significant unrealized gain, you have to execute your plan. Either close a portion or move your stop loss to lock in that capital. The market can and will snatch it back in an instant.
Okay. Mistake number 2 is that silent killer we discussed earlier.
Ignoring funding fees, especially on positions you hold for a while.
The fix here is procedural. You just have to check the funding rate every single time it resets, usually every 8 hours. You have to know if you are paying or receiving interest and make sure those costs aren't quietly killing your net PnL.
And if the funding rate is high and it's against you, it's often better to just close the position and reopen it later.
And the third mistake, this one screams of a lack of preparation.
Not knowing the tick value of the asset you are trading.
This speaks directly to disciplined position sizing. The fix is to calculate exactly how much each small price move costs you in dollars before you enter.
Yes. If you know that every point the asset moves equals $10 in PnL for you, you have a much better gauge of your risk than just seeing a percentage change fluctuate.
You have a dollar-based perspective.
Exactly. A dollar-based perspective on your exposure, which is critical for proper risk management. And to synthesize all this, we should leave you with that essential pre-trade checklist from the source material. It forces a trader to analyze risk before commitment.
It's called mandatory reading for anyone using leverage. What are the 5 pillars?
1, confirm your direction. Are you confidently long or short? 2, calculate your total position size margin times leverage so you know your actual exposure. 3, identify your exit price. Where are you taking profit? You have to have a target.
And on the risk side, 4, identify the stop point. At what price is the loss just too great? That defines your maximum acceptable dollar loss.
And finally, 5, check the costs. What are the expected trading and funding fees for this specific position? If you can answer those 5 questions with certainty, you've mastered the discipline needed to survive.
So what does this all mean? It means leverage is a powerful but profoundly unforgiving financial tool. The small amount of margin you post is entirely deceptive. Your actual profit and loss are calculated on a much, much larger position size. The difference between gross and net PnL can be huge, making fee calculation and liquidation awareness absolutely critical. Without fully realizing your true position size, you are simply trading blind.
Building on that final warning about sizing and survival, for
Yeah.
truly successful long-term trading discipline, the most important calculation is never the potential P&L percentage. It's not the maximum gain you could achieve. It is the specific, predetermined dollar amount that, if lost, will not alter your overall ability to continue trading tomorrow.
That's the key.
Shifting your focus from maximum potential gain to pure capital preservation. That's the difference between a one-off gambler and a career trader.